Welcome to today's topic where we'll talk about shares and equities as we continue the discussion on the type of investment vehicles that are available to individuals. So we have 7 of them, and today we're going to talk about shares. So what you're looking at right now is the Lusaka Stock Exchange website, and it does explain how one can go about the investment in shares, and it's also easy to access as I'm using my phone right now, which means it's something that can be accessed by anyone from anywhere. And yeah, so let's dig into what shares are and how someone can actually invest in shares. So what are shares? A share is simply having a portion of something. So if you bought a loaf of bread and you have the 4 of you and you cut it in 4 portions, then each portion becomes a share that belongs to the group, the 4 of you. So even when it comes to companies are allocated or apportioned into shares, and based on the requirements of PACRA, any company, the minimum shares that can be in a company or authorized share capital in a company is 15,000. But this number, the authorized share capital, can be pretty much any number depending on the needs of the company. But the minimum is 15,000, and you need to have a minimum of 2 shareholders. So for private companies, the shares of those companies are just available to the private individuals, the people that this company decides to deal with in order to invest in those shares. That's on a private level. Whereas you have a public company, and a public company is one now that lists its shares on an exchange like the Lusaka Stock Exchange, and people can therefore buy and sell those shares for that company publicly. And yeah, that's the opportunity that comes in now, where people can use this as an investment vehicle. So what type of markets do we have when it comes to the issues of shares? We have 2 types of markets. We have the primary market, which is the market where the company first issues out its shares, and this is called the initial public offering, or IPO. If you've heard of the term IPO, it's just the initial public offering, where the company, say, has an authorized share capital of 2 million, and they decide they want to raise capital, say 500,000. So they're going to get 500,000 of their shares, and they'll put it on the market. If this share price per share is 1 kwacha, and they put out 500,000 shares, then the people that, once people buy those shares or invest in those shares, then they're going to raise the 500,000, because there are 500,000 shares and each share is worth 1 kwacha. So if people pay 1 kwacha per share and all the shares have been bought, then the company would have raised 500,000 kwacha. That company can then use that 500,000 kwacha to run the business, to expand, to pretty much use the funds for them to make business or in whatever venture that they want to do. So companies, they have different reasons why they'll put out their shares on the public, and mainly it's to raise capital, but the capital can be raised for any different reasons. Now, once those people buy those shares no longer belong to the company. These now become properties of the individuals that bought those shares. And these individuals or companies can therefore also sell these shares, or they can buy shares from other people that already own these shares. And this trading and the buying and selling of these shares is what then happens in what is called the secondary market. So the secondary market is where the Lusaka Stock Exchange falls. So the Lusaka Stock Exchange is a place where people can buy and sell their shares. So how can you invest in these shares in Zambia? And we're talking about the publicly traded, publicly listed companies' shares in this regard. So how can you do it? So, yesterday we talked about the government securities. You can deal directly with the government, and you can register with the government and with Bank of Zambia, and Bank of Zambia can sell those bonds to you. You can lend them money directly without an intermediary. But when it comes to shares, there is an intermediary, and these intermediaries are called brokers. So as at 2020, there were 6 brokers, and the functions of a broker is they offer technical as well as infrastructure resources that help investors to invest as well as to save money. And the broker can help you with other services as well. They can be consultants, they can be fund managers, they can be wealth managers, they can help you to plan, and they can give you all the information that you need or strategies that you need to employ in order for you to have a successful investment journey. So once you choose the broker that you want to work with, you need to open an account with that broker. But for you to open an account, they need to carry out know your client or know your customer procedures. These are simply KYC, and they'll need the proof of your residence, which can be a bill, a utility bill like water or Zesco, and they'll need the proof of identity. Proof of identity can be your NRC, it can be your passport, or it can be your driver's license. And you complete a form that you submit with them. Once your account is open, then you can choose which shares you want to buy, and once a transaction has been done for the share that you want to buy, then the broker will make a commission at the rate of 1.375%. So, how do you then buy these shares on the Lusaka Stock Exchange? Through the broker. So you are going to tell the broker either the amount that you are bidding to buy these shares at. You can put in a price that you want to buy them at, and the broker will push that on the market. If there's a seller who is willing to sell those shares at the price you have quoted, and then there's a match, then that deal would be completed. You'll be sold those shares, and the broker will get their commission. Or if you want, you can also put the price at the market price. Whatever price is on the market, you put in the amount at that price, and those deals are usually quicker because they are already there on the system, and then they'll match the two, and you would have bought those shares, and the broker will make their commission. So this is pretty much how the buying and selling of the shares happens. So what are the benefits that you get for actually owning these shares? There are mainly 2 benefits one gets from owning of shares. One, when you buy shares today, say at 1 kwacha per share, if the company is performing well, there is a high probability that the share price is going to increase. And that increase in the share price is called a capital appreciation, meaning your capital has grown. So when you decide to sell these shares at a later date, you are going to make a profit, which is the price you sell at compared to price that you bought those shares at. That difference will be your profit. Secondly, these companies every year, when they make a profit, or if they make a profit, there is a percentage that they are going to pay to their shareholders, and this percentage paid to the shareholders as a component of the profit is called a dividend. So you're going to be earning dividend income from having these shares. And yes, you can pretty much sell these shares as and when you need to sell them. We're hoping there will be a willing buyer at that time. So that's how people can make money through the issue of buying, through the investments in shares. Now, what strategies can someone use when it comes to share buying? When you look at it in a nutshell, you have got 2 strategies here. You can use a strategy where, okay, there are 3, but anyway, The two are that you can actively monitor which shares you think are going to perform well, and those are the companies that you buy the shares in. Take, for example, you look at the company's performance, the current performance, the dividend that they are paying out to their shareholders. You look at the future prospects, you look at the economy, how it's going to grow, where is the government likely to push in more money, in which industry are they likely to put in more money, and therefore that industry is going to thrive. And if the company thrives, then there's going to be prosperity. That company will be making profits, paying out dividends. The more they make profits and pay dividends and perform well, the more people will be attracted to buy those shares. The more the demand for those shares, the more the price will increase, because prices of shares mainly move because of demand and supply. If people are buying these shares because they've seen that there's value, then those who own the shares will have a bargaining power, therefore they will increase the price. But if people think this company is making losses, it just doesn't seem like it has a proper future, then people are likely to start selling. The more people sell, the more the share price is going to fall. So you can actively choose which which shares to buy, and you can actually do this in a short term period where you buy for short-term purposes. You buy this month, 2 months later when the price goes up, you sell. You buy in another company, when the price goes up again, you sell, and you are just making those profits. You are actively trading in these shares. Or the second alternative is where you buy shares in companies that you believe in and you hold those shares regardless of the current fluctuations and whatnot. You do not care about those fluctuations, just looking at the longer term. So you buy these shares and you hold them, say for the next 15 years. Then in the 15 years period, then the value of those companies, you expect them to have grown, and therefore you make money through the dividends that you receive on an annual basis, as well as the capital appreciation. So those are two strategies, which is the trading or the holding. But then there is also a way that you can do it in the sense that you diversify your portfolio, where you get say an you diversify your portfolio. You get say an index. You can invest in the entire index of the share, in the entire index of the stock of the market. So you can get the entire, you can just put on the index. That's where you invest in, or you can select a number of companies and you create your own index. This index means that you diversify. You're not just putting all your eggs in one company. So you're putting in a different number of companies. This one usually works and helps in the sense that it smoothens your returns, especially if you've put in companies that are in different industries or sectors, and if the entire economy is performing well, then you expect that you're going to make money in the long run. But if the entire economy is not performing well, even if you diversify in that manner, you might still get a hit. But there are a lot of strategies that you can use in terms of investing in shares. Or the other one, you can actually just use the same fund management, where you use a broker. They are the ones that manage your funds. Yeah, you can either use a broker, or you can use these other asset management companies, and they are the ones that will be managing your funds. They will buy shares in different companies. All you do is contribute that small amount. And when it comes to shares, you can buy shares even for as little as 500 kwacha. Yeah, and that is something that you can therefore afford, in the sense that you can buy shares even in the small capped shares, the ones with the small prices, and you can buy a lot more of them even with little money. And as long as your strategy is more long term than short term, you are likely to make money in the long run. But everything comes with a risk. When it comes to shares, it's not like the government securities where they are risk free. When it comes to shares, there are risks, and these risks are mainly in relation to the fact that these companies can make losses, these companies can go under. If a company goes under, then you, the shareholders, are the last ones to be paid. But you only lose up to the extent of your investment in these shares. So that's pretty much how shares operate and the strategies that you can use. And yeah, we'll continue tomorrow and we talk about another asset class. Thank you for your time. Have a good day.